Martin from the Philippines. We're here in Real Talk Lifeline. So, welcome to the Money series today. And we'll be talking about insight into high net worth wealth. So, what is this? There was a very recent event that just happened yesterday, and there was a guest speaker, and he was talking about insight into modern trends in wealth management. So I'll be speaking here partly as just a regular, random, common person. And I'll also share perspective as someone who's gone through training as a certified wealth planner. So I'll share with you insights into how the high net worth handle wealth, see wealth, and then I'll also break it down for you. So for that, let me share my screen. I'm gonna go open up my stories actually. This happened super recently, so I'll just blow it up here. Boom. Open up like this so you could see it more easily. Opening up my stories. I'm just gonna head right to this. Here just happened yesterday. So let me check on you guys real quick and let's dive right into it. So this was a wealth forum which happened yesterday at the Makati Sports Club. Now, the good news is for those who haven't attended it, well, you're in luck. So I'll be sharing with you some quick notes. So this is just open sharing, more conversational. Of course, if you're more formal and serious, please do your due diligence. Um, you know, you can always reach out for a different coaching or like one-on-one session on that. So, the quick notes of this one. So, Mr. Martin Wong, he's the regional CEO of Grandtag Financial Consultancy. They're based in Singapore. So, he was the guest speaker. So, what are, in summary, the three key points that were shared? So, number one, certainty of a future hedge. Number two, certainty of future free cash flows. So some of these terms might be familiar to you already. And then lastly, certainty of downside protection. So I'll break it down these three quick points for you. Again, this is how the high net worth uh, clients or people that you meet, individuals, see wealth. So number one, before we dive into it, for high net worth clients, wealth management is often less about beating the market, meaning investing, gains, right? And it's more about stability, predictability, and preservation. When dealing with significant capital, and you'll see the numbers in a bit, the mathematical impact of a loss is much harder to recover from the benefit of a gain. So here's the breakdown of those three overriding concerns. Again, these are trends or concerns of the high net worth clients. And you will see shortly the amounts involved. Again, offshore, this is based on Singapore guest speaker. So I'm going to open this up a little bigger just so I can see this more clearly and walk you through it. All right. So number one, certainty of a future hedge. High net worth individuals often have wealth concentrated in specific areas. So it could be a family business, specific real estate market, or a single industry. A future hedge. So I'll also try to explain this in simple terms. A hedge is, simply put, it's kind of like insurance. So if something bad happens, you have protection or an upside to it. So a future hedge isn't just about diversification, it's about systemic insurance. So, what's their concern for this first point? They need to know that if their primary engine of wealth, so this is their focus, maybe they're into tech stocks, maybe they're into not just real estate, but luxury real estate, because this is the high net worth. Let's say they face a structural downturn. So something bad happens, they have losses. What they want is they have an uncorrelated counterweight that will gain value. So, what does that mean? If they're focused on real estate and real estate is starting to collapse, right? The market is going down, which could happen. Some people think that real estate, the prices just go up. But if you look at the US, again, this guy is based in Singapore, even locally, it could happen. The prices of real estate can just stay for a very long period 8 years, 10 years, even more. And in certain areas, I actually learned this the hard way from another mentor, the prices can go down. So if there was an earthquake near the fault line, etc., whatever, it's actually possible that real estate values can go down. So the goal is achieving a mathematical negative correlation. So this often involves gold, specialized derivatives, or alternative currencies. So derivatives, that's like a fancy term for options or futures. So what that is, again, in the simplest term that the most common person could understand is it's like insurance. So if something happens, you can have an upside or benefit just in case. Of course, it's much more sophisticated or complex, but you could do your due diligence and go deeper into that. Why does this matter? For these clients, a hedge, again, the term hedge is a sleep at night factor. They aren't looking for the hedge to make them rich. They are looking for it to remain liquid and valuable when everything else is on fire. So you'll also see some terms later on here for the high net worth. So liquidity or this future hedge is like the first main point. Number two, certainty of future free cash flows. So this is kind of related just on how that note ended. So because cash flow is also related to liquidity. While net worth is a vanity metric, cash flow is sanity. So that first line is very powerful. Now, for people who are not high net worth yet, net worth is actually important. So you can check the money playlist on net worth or how to compute your net worth, which I did previously. And that's just the first check. So people who are unaware, even when you ask them what is your net worth, they don't even know what their worth is. So that's, let's say, the poor, again, for lack of better terms. And then the middle class, a lot of them also still aren't aware of their net worth. They just work. A lot of them get into debt like that. So part of the net worth computation is your assets minus your liabilities. Liabilities is your debt, your utang, your IOU, right? You're making payments, whether it's for a car, whether it's for a loan, whether it's for borrowing money, etc. So net worth is actually very important. So why do they call it a vanity metric here? So many high net worth clients are trapped in wealth that is illiquid. So they can't sell it easily for cash. So private equity, art, property, and they require a guaranteed stream of liquidity, which is the cash flow, to maintain their lifestyle. What is that? They pay taxes, they fund new ventures of businesses without being forced to sell assets at a discount. What is the concern here? Am I liquid enough to survive a 5 year freeze? So, people who think that's unrealistic, look what happened to COVID back in 2020. So, they're very experienced or they understand that in history this could happen. They worry about sequence of returns risk. So what is this? The danger of having to withdraw capital during a market crash, which permanently depletes their principal. So the high net worth think very differently. They think about this. For financial advisors, consultants, wealth planners, this type of training actually exposes us to this. And I also learned to think this way. The goal is to create a ladder of income generating assets. So bonds, private credit, or dividend heavy portfolios that that cover all annual liabilities regardless of market volatility. So this line, I love it. The way of thinking is a lot of high net worth clients, they're into real estate or illiquid assets. It's good to have those. That's how they amassed so much wealth. It's part of the it's part of their portfolio, part of their asset, how they built it over time. But cash flow, that's the point of this one. The certainty of future free cash flow. Build also assets that are income generating. So the returns may not be as big as a business. They might not be as, again, big as real estate, capital appreciation, but they have monthly, quarterly, semi annual, or annual cash flow coming in to pay their lifestyle, their taxes. Lifestyle, by the way, could just be operating expenses. So it's not to be fancy, it's just to pay their life because they have to pay on a daily basis. So the next one, number three, this is the last point, certainty of downside protection. So they're all interrelated. A hedge, there's cash flow, liquidity, and then downside protection, number three. So we're starting to see the numbers now. What is a high net worth client? For a client with $50 million, so that's dollars here in the Philippines, that's like you're, man, I think you're a billionaire already. Well, multiply that by 50. That's the shortcut. It's actually more. So a 20% drop isn't just a number. It's a $10 million loss, and it may take years to recoup. So this concern focuses on capital preservation over capital appreciation. So a quick note over here, as a financial consultant or advisor in training, they teach us or they train us this pyramid. So there's um it's first protection, wealth protection, wealth accumulation, and then wealth transfer. So many people may disagree with me. So I'm just speaking from experience and what makes sense to me. Normally, clients start with wealth accumulation first. Because if you say protection first, and it's a strategy to just like sell insurance, right? Sell products. Personally, my mindset is I need to acquire first, accumulate wealth. Because if I don't have any wealth, I can't protect anything. If that makes sense. So what this is the high net worth. They accumulated wealth over years, decades, generations. And now their focus is to protect it. So there's actually a level above it. Wealth transfer deals with estate planning already, but that deals more with death and succession already. So this is for the high net worth clients who want to protect their wealth now. So that's capital preservation. The concern is the asymmetry of returns. So what does this mean? If a portfolio loses 50%, it requires 100% gain just to get back to even. So when there is a loss, what this means is it takes two times the effort just to go back to ground zero, like the base level. High net worth clients are hyper aware that avoiding the big miss is more important than catching the big win. So this is very different way of thinking. A lot of people who start, they just want to win. They just want to make gains. They want to get big returns. So I'll explain it here in the end why the high net worth think this way. The goal is implementing structural floors on losses. This is often done through structured products. So, what is this? Investments with a defined buffer. For example, the first 10% of market loss is protected. So, some of you may be familiar with this term, the traders. Stop loss mandates. What is this? Automated triggers to move to cash or defensive positions. All this means is they they have a way, a system, that if their investment starts losing money, 5%, 10%, it's going to stop that loss from further losing any more money. So the ending of this, why it matters. Most high net worth individuals have already won the game. They already have built so much wealth. So their primary objective is to ensure that they don't have to play it again from a diminished position. In other words, they don't want to lose it all or lose a lot of it and then have to do it all over again. So let me stop this screen share, exiting this, heading back. Let me go back to you guys over there. So I just want to wrap this up. So on this money series, if you like this one, you can comment down below money. If you like these topics, we just talked about an insight into high net worth, wealth, the way they see it. Super quick note sharing, because if you were able to attend the event yesterday, I think it was like an hour or more. So I'm just sharing with you the good stuff. Comment down below what your favorite or key takeaway was. If you're a financial advisor, maybe you're also a colleague, like you have teammates, or you are a client and you learned something from this. So thank you. I love you, and I will see you next time.